The US dollar has been the world's reserve currency for 81 years, but that dominance is quietly crumbling right now. The Guardian just published trust in the United States dollar is eroding. The question isn't if the dollar will lose supremacy, it's when. JP Morgan is warning about de-dollarization, the dollar losing its dominance. BlackRock, the world's largest asset manager, says a declining dollar means you need more international exposure. So Winston just said to me, if you're holding all your wealth in US dollars and US stocks, you could be sitting on a ticking time bomb. That's really what he just said. So your savings, your retirement, your purchasing power, they're all at risk. Now, by the end of this video, you'll understand exactly what's happening to the dollar, why it's happening, and the 4 strategic moves wealthy investors are making right now to protect and grow their wealth. This isn't about panic or doom and gloom. It's about being prepared and positioned. My name is Felix Prehn. I'm an ex-investment banker. That was Winston there, most importantly. And I've seen how institutional banks work. I'm also the founder of the Goat Academy, where we've taught over 20,000 students and helping them to learn to invest like the pros. And I'm also the co-founder of TradeVision.io, where we analyze markets and investment opportunities daily. My mission is simple: teach regular investors like you the same strategy that the Wall Street guys use to find winning opportunities before the crowd does. And today I'm going to break down what's really happening with the US dollar. No hype, no fear-mongering, just facts. I'll show you the 4 asset classes that wealthy institutions and investors are moving into right now. And I explain how you can position yourself strategically, whether you have $1,000 or $1 million to invest. The US dollar became the world's reserve currency on the back end of World War II in 1944, and this move made America the world's economic superpower. One of the key reasons the world trusted the dollar, it was backed by physical gold. Now, here's how the system works. The US government generates revenue from taxes, which you may be paying. They then spend that money on healthcare, welfare, infrastructure, military, sort of everything the government does. But here's the problem. The US does not run a balanced budget. The government spends way more than it takes in through taxes. So where does the extra money come from? The government borrows from people like you and me through treasury bonds. We lend money to the government in exchange for interest. But they also borrow from foreign countries. Countries around the world lend money to the US government because they trust it. They want to be paid back with interest though. And then you have the Federal Reserve, which basically just prints money. If the government can't get enough money from regular people like you and me and foreign governments, they go to the Federal Reserve. The Fed then just hits the money printer and gives the government that money as a loan. Now here's something wild. The Federal Reserve isn't actually federal. It says so on their website, check it out. They're not a bank because you can't deposit money there. They are not a reserve because they don't sit on cash reserves. But they have the ability to create money out of thin air. Now when the US dollars were backed by physical gold, there was a limit on how much money the Fed could print. Why? Because to print more dollars, well, they needed more wealth, more collateral. And that collateral was physical gold. This gold-backed money helped preserve the value of the dollar. But it also slowed down economic growth because the US economy runs on what? Spending. Yes. The more money you spend, the more money somebody else makes. And the largest spender in the US economy isn't Amazon, Tesla, or you and me. It's the US government. So when the government spends more on infrastructure, research, contracts, that money goes into businesses' pockets and then into investors' pockets. But imagine if the government could just print money out of thin air with no limits. By the early 1970s, the US government had borrowed so much money, not just from the Fed, but from countries around the world. Foreign countries started getting concerned about America's ability to pay back that debt. So these countries said, you know what? Keep the dollars. Just give us back all our physical gold. Gold levels in the US started dropping because everyone who'd lent the US money wanted their gold back. And that's when President Richard Nixon made a historic move. He severed the tie between the US dollar and physical gold. And here's what Nixon said: "I've directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold." Notice the word temporarily. Well, there we are 54 years later, and the dollar is still not tied back to physical gold. And this move started creating concerns about inflation, because if you can just print money out of thin air, and that money isn't backed by anything, it's just backed by a promise that the US government has value, it's backed by a promise the government will continue to pay its bills, well, the dollar was still the world's reserve currency, but people started getting concerned about its value and inflation. Those concerns were relatively quiet after the 70s until 2008. And if you're wondering, Felix, what stocks should I be investing in right now? You need to understand what's happening so you can make better decisions. That's kind of the key part here. But if you're impatient, then I'd say to you, come and join me. Leave this video right now and join me for a live training where I will actually teach you how Wall Street finds those great stocks. And you can do that by signing up at felixfriends.org/training. And the link is down below in the description. And then you don't need a history lesson here because maybe you haven't got the patience for that, but you need the skills. I'll give you the skills in that separate live session that we're going to run on Tuesday evening. Now, after the housing market crashed in 2008, the economy was in freefall. So the Fed unleashed something called quantitative easing. It's a fancy word for saying we're going to print $1 trillion out of thin air and inject it into the economy. So the Federal Reserve printed more money and gave it to the US government. The government then spent that money hiring people, building contracts, giving money to businesses to keep the economy moving, bailing out the occasional bank because, bankers they really need it. And then after that quantitative easing starting in 2008, people got concerned about the value of the dollar again. Because if you can just print money out of thin air, what is the real value of the dollar? It's a valid argument. You can print money. Why do we have to pay taxes? Why do we have to work for money? You can just print it, right? Now, by 2012, it looked like things were okay again. The economy started moving again, the dollar was still strong, and concerns around the dollar started calming down a little bit. And then 2020 came, and things got flipped upside down again. When the pandemic hit in 2020, the economy shut down. The stock market saw its fastest sell-off since the Great Depression, and that's when the Fed started printing money again. Now this time, they didn't call it quantitative easing, but it's essentially the same thing. It's estimated the Fed printed around $5 trillion to stimulate the economy. Now it's hard for our brains to process how much $5 trillion really is. Let me help you understand it. In 2019, it took 300 million Americans working for 1 year to produce about 21 trillion of wealth. The US economy was about $21 trillion large. So when the Fed printed about a quarter of that with their magic button, think about that. 300 million people working a full year versus a button. And this new money printing got many people very, very concerned about the dollar again. But interestingly, during the same time, many economists were saying, no, all this money printing is not going to cause inflation. Now, I don't know if those people were just like thick, high, or paid, but inflation did happen. And that's when interest rates went up. So when we started seeing inflation in 2021, the Fed said it's a transitory problem, as in a temporary problem. Now here we are, 2025, 5 years later, after all that money printing, and we're still dealing with inflation. So let's recap where we are. 5 years after the pandemic money printing machine, nearly 2 decades after the 2008 money printing, about 5 decades after Nixon took us temporarily off the gold standard, and 81 years after the US became the world's reserve currency, and people are starting to get more concerned about the value and the health of the dollar. Now we're seeing major institutions and publications raising red flags. You've got the lefty lobbies of the British press saying the question isn't if, but when the dollar loses its supremacy. JP Morgan, probably someone worth listening to. Can you hear my cat back there making a racket? De-dollarization is underway. And BlackRock, the guys with all the money, they're saying Bitcoin could replace the dollar. They're literally the world's largest assets manager, and they say a declining dollar means investors need to change what they're doing. This one's getting concerned about her dollar assets. But yeah, the CEO of BlackRock recently did an interview where he said the US dollar could be replaced by Bitcoin because of all the national debt. These are not random YouTubers or conspiracy theories. These are the biggest financial institutions in the world. This is Sabrina, by the way. Now, they're not saying the dollar will collapse tomorrow, but they are saying the dollar's dominance is being questioned for the first time in decades. So what does it actually mean for you? Well, first of all, don't panic. But now that you understand what's going on, let's talk about what this actually really means. Now, does this mean you should come to a rash conclusion? No. Does this mean the dollar is going to crash tomorrow? No. It means you need to understand strategically how to allocate your money. Now, for full transparency and full disclaimer, I still think the US is the best place to be and the best place to invest. But we can start to study what some of the rich people, the wealthy institutions, the big banks are doing to diversify themselves, because we can learn from others. And that's always the way I've learned, from mentors who are more successful than me. So my team and I have been studying, that's Sabrina and Winston, some of the largest asset managers and investment institutions in the world, and we saw a theme. There are 4 places that investors are looking to diversify their money if they have concerns about the dollar. Those 4 places are: number 1, physical gold; number 2, real estate; number 3, foreign stuff; and number 4, Bitcoin. So let me break down each one so you understand the opportunities and the risks. Now, none of this is financial advice. I'm not telling you what to do. My hope is that you come away here with a heck of a lot better understanding than you started off with. And if you then want to take it further, go and join me live at felixprehn.org/training on Tuesday night. Starting with physical gold. It takes time, effort, and labor to mine physical gold. There is a limited supply of physical gold in the world, and gold has been the historic form of money for literally thousands of years. And that's why some investors who are concerned about the dollar and inflation will buy gold. And I agree with them. Another reason gold prices have been booming over the last few years is that the BRICS nations, that stands for Brazil, Russia, India, China, and South Africa, these countries have been working to potentially move away from the US dollar and create their own currency that could be backed by physical gold. They've also seen that they are buying less US dollar debt and instead just buying gold because they can lock it up in their own safe. But I want you to understand, nothing goes up in a straight line, including physical gold. And I'm telling you, this is somebody who likes his gold exposure. I'm bullish on it in the long term, but we might see a little bit of a wobble over the short term. At least that's my perspective. Now, gold prices boomed after the 2008 crash because everybody was concerned about the dollar. So people looked for ways to protect themselves. And by 2012, it became clear that the dollar was, well, sort of safe-ish, or people had forgotten about 2008. And people didn't want a safe investment anymore. They wanted to make higher returns. So they dumped gold and they went back to normal investing. And then gold prices fell from 2012 through to 2013, 2014, 2015, 2016, all the way to 2020. And it took 8 years for gold prices to recover after 2012. Now, let me tell you how I think about gold. And I'm not a financial advisor. I can't tell you what to do. If I buy, say, $10,000 of gold, I don't really look at it as an investment. I look at it as that it will be worth more than $10,000 of cash because inflation will undermine the cash value. So the gold will have more buying power in the future because of inflation. That's my thought. But bear in mind, gold goes down when people feel confident about the economy and they want to be, in robots or AI or whatever again. Now, the second piece where we're seeing a lot of money flowing is physical real estate. I like real estate, and here's why. Unlike gold, real estate can produce an income, and therefore it has real value. Real estate is a hard asset, something you can see, feel, and touch. And when you own real estate, you own the bricks, the land, the windows, and so on. Whereas with physical gold, it's just sitting there looking back at you, producing no income. So real estate can work for you and actually generate an income, and that's the advantage. Now, if the value of the dollar goes down, the price of real estate would likely go up along with rental prices. And hypothetically, worst case scenario, and I'm not saying this is going to happen, but stick with me for this example, if the dollar were to collapse, which I don't think is going to happen on an extreme level, it'll be gradual, and the currency became worth nothing, you could charge, say people started trading in chickens, you could then charge rent in chickens instead of the US dollar, because that real estate still has value you can exchange for whatever form of money or new currency exists, right? Now, it might be Bitcoin rather than chickens, so it might be a little bit more practical, but that is why real estate is powerful. It's a physical asset, produces income, it hedges against inflation, and it has real utility. People need places to live and work. Now, thirdly, foreign businesses. So instead of investing your money only into US companies, which are heavily affected by the US dollar, some investment institutions have been looking at foreign companies and foreign stocks. Now, investing in different economies can be difficult, especially if we don't know how they actually work and what their regulations and taxes are and so on. But there are much simpler ways by using the US stock market to get exposure to funds that give you ownership in those foreign companies. And you can do that through ETFs, exchange-traded funds. Now, before I continue, I am not telling you what to invest in. Investing has risks and you never are guaranteed to make your money back. In fact, you will likely lose money at some point. So make sure you do your own due diligence. Never just blindly follow a guy on YouTube, even if he has noisy cats. But there are ETFs out there that you can buy in the US that'll give you instant exposure to foreign economies. So let me give you a couple of examples. Again, not telling you what to buy. One is VEA. Ticker symbol is VEA. It's created by Vanguard, one of the largest investment institutions in the world. And it gives you exposure to developed economies outside the US. So these are the more established countries all around the world, and you can get exposure to those economies by investing in this fund, which owns stocks in those economies. An alternative is IEMG, which is created by iShares, again, a BlackRock, very large institution. This one invests into emerging stock markets. So we're talking about smaller economies, smaller countries that are growing. More risk for more potential return? Possibly, because not only could you see the companies grow, but the countries could also grow, which means, yes, you could see a potentially larger upside, but you're taking a lot more risk. It's not the same as the US economy. It's not as secure as the US economy. Right. Now, the fourth place is Bitcoin. Bitcoin is the newest asset class really out there. This is something that was created to be a digital asset, kind of like physical gold. However, we've seen a lot of volatility with Bitcoin, which means it goes up and down a lot. And we've seen a lot of Bitcoin crashes over the last 10 or so years. Yes, people look at Bitcoin as the digital gold. People use Bitcoin as a way to protect themselves against inflation or the falling dollar. However, it hasn't been around the way gold has, thousands of years, or real estate has, thousands of years, or investing in stocks has, well, certainly hundreds of years. So Bitcoin comes with additional risk, more potential upside, more potential risk. And your job as an investor is to be able to manage the risk, manage the upside, and find the right investment opportunities for you. Now remember, even the CEO of BlackRock mentioned that Bitcoin could potentially replace the dollar because of the national debt. And that's a huge statement for somebody who manages the largest asset manager in the world. So it shows that Bitcoin is being taken seriously by the big boys. But here's the key thing. It's important for you not to panic, but to understand what's happening. A lot of people tend to get very emotional, and emotions are the enemy of profits. Any changes that happen are slow moving. By watching this video now, you're ahead of the vast majority of the population. And I want you to understand what's happening and be able to position yourself in a way that can capitalize on what's happening potentially. But the only way you can do that is by understanding how it creates the opportunities. So let's recap this briefly. The opportunities to get out of inflation in the dollar is gold, it's real estate, it's foreign stuff. If I could spell foreign, you get the idea. Foreign. And then there is Bitcoin. Now, you could argue that being in highly profitable, solid American businesses, which could simply raise prices as the dollar keeps losing value, could be a place to be. And I think there is an argument to be made for that. But please, please, please do not invest out of fear. Invest out of strategy. The dollar isn't going to collapse tomorrow, but the landscape is changing, and those who understand what's happening and position themselves strategically will be the ones who are more likely to thrive. You want to learn how to spot the winning investment opportunities before the crowd does. If you want to understand how Wall Street analyzes stocks and builds their portfolios, then come and join me for the live training at felixprehn.org/training, and I'll teach it to you. It's free of charge. All you got to do is grab yourself a seat and be on time. If you got some value out of this, share it with a friend, and I wish you all the best. If you're sitting on cash right now, wondering where to invest this year, what I'm about to show you could be the difference between missing out and catching some of the biggest opportunities in tech, healthcare, and AI infrastructure.